Virtual reality is a different market segment than social media. Social media users will not move to virtual reality as it misses the point of the communities these people are trying to build. Meta's move into virtual reality is not a natural progression and will prove to be difficult. Why is virtual reality different from social media? To understand why virtual reality is different from social media, we need to define them. Starting with social media is a platform that enables people to create, share, and exchange information, ideas, and content online. While some of this content revolves around the digital world, the vast majority of it has ties to the physical world. In contrast, virtual reality is a completely digital experience. It attempts to simulate a world environment and thus has no connection to the physical world. It is thus a form of escapism from the real world, while the traditional social media space is a glorification of the physical world. Women, social media whales. The real issue for Meta is their key demographic. Meta's key advertising driver is women. Women are the whales of social media and advertising in general. A whale typically refers to a high roller in a casino. In this case, women are the whale customers Meta targets. While the media may depict women as low earning, downtrodden members of society, the numbers tell a different story. Data aggregated by Girl Power Marketing shows that Forbes reports 85% of consumer spending being controlled or influenced by women. 60% of all personal wealth is controlled by women, and 40% of women now out-earn their husbands. The female consumer is stronger than ever and only growing stronger. When we look at the demographics of social media websites, we see a similar dominance of women. According to Pew Research Center, 78% of women surveyed use one social media website compared to 66% of men. When we focus specifically on Facebook, the breakdown is 77% women compared to 61% of men use the app, and for Instagram, it is 44% of women compared to 36% of men. Women are clearly the dominant users of social media, with a growing wealth to be advertised to. Meta and advertisers should be focused on women if they want to target Meta's core audience. Analyzing how women use social media, women on average utilize social media to connect with others, build relationships, share experiences and ideas, and find support and inspiration. Social media allows women to express themselves, show their talents, and feel connected to a larger community. A larger, real-world community. This, however, is hampered greatly by a focus on virtual reality. Virtual reality is a complete escape from reality. While we may desire breaks from our lives, this does not necessarily mean we want to be moved to an alternate reality. Social media, even when based in the real world, can be an escape from your life. On the other hand, virtual reality is an escape to an entirely different world altogether. It removes a core reason people use social media, to feel connected to the world even if it is at arm's length. Social media users can decide what and how much of themselves to share and what and how much of other people's lives to consume. Virtual reality will provide a different sense of connection and community than social media does. Case study: Kim Kardashian. We can get a better understanding of the pitfalls of virtual reality by looking at a social media star like Kim Kardashian. Would Kim Kardashian move to a virtual reality? By looking at her, we can decide if other users like her or who look up to her would also move. Engaging in this thought experiment, let's think. Would Kim Kardashian put on VR goggles and spend time in this world? Most likely not. As a wealthy person, she has every experience available to her. She can sit in a digital experience of racing a car or flying a plane, or she could actually just do them. While there are some experiences she can't do in real life, the abundant number of ones she can do limit her time in virtual reality. Next, we can think of what social benefit this would offer her. Here, I would say it would be minimal. While she may be able to engage with fans in this medium, fans would be more happy with a real world physical picture of her life than seeing her digital avatar. In fact, the time in her digital avatar would hurt her ability to create the real world content her fans crave. And finally, we can think of the moat of her brand. In the real world, her image is hard to replicate. It would take a lot of silicon, surgery, and time in the gym. In the digital world, she can easily be replicated, as it is all lines of code. This could prove to be a massive hurdle for virtual reality. Social media stars are called influencers for a reason. What they promote matters, and they have an incentive to denigrate virtual reality. Influencers will want to keep users on the platform that they hold an advantage on. Describing the VR user. I want to now talk about the core customer virtual reality will target. Virtual reality currently targets the gamer segment. This is because it improves upon the gaming experience and it is proven by the excitement around the technology. This also should be a red flag, as women, the core audience for Meta, are not excited for it. This means Meta needs to garner the trust of gamers, which it somewhat has done through its acquisition of Oculus. This is starkly contrasted by a virtual reality product targeted to gamers. The PlayStation 5 Virtual Reality 2 is the perfect example of this. Recently released, it provides one of the most premium virtual reality gaming experiences we have seen to date. Gamers seem genuinely excited for this. While Meta has spent $31 billion on virtual reality to gain begrudging acceptance from virtual reality users, Sony has spent $5.5 billion, a fraction of this, and has gained far more acceptance. This puts further doubt in my confidence Meta can succeed in this realm. Sony seems to be far more efficient in their capital spend. One caveat I will mention that may explain the large discrepancy to these spend amounts is that Meta is investing in game studios, and thus we may not have seen the full impact of this spend as games may still be in the pipeline. Now, to be clear, the Sony device is $1,050 when you factor in the base console and the virtual reality device, but the technology will come down in price, and I believe the user base Sony will build will be far more sticky and loyal than Meta's user base. The PlayStation has always had a loyal fan base, and Meta's competition is finally ramping up. Meta may have popularized virtual reality to the mainstream, but Sony may end up building the killer virtual reality experience that captures the majority of users. Conclusion. Virtual reality has been pitched as the next logical step of social media, but it is clear that it serves a different purpose. Virtual reality offers new, amazing experiences that are extremely immersive. While this is exciting, we cannot let this excitement cloud our judgment of the market potential for this product. Meta's spend is currently hard to justify given the financials of players in the industry. I will utilize Microsoft as the best case scenario. Their gaming division makes approximately $5 billion a quarter based on the results they have provided from Q3. They do not say this exactly, but if we extrapolate a 13% decline and $684 million as the decline, we get the total amount to be $5 billion. This would be a $5 billion operating profit a year at a 25% margin. Keeping the math simple, as complicating it only further proves the point, it would take Meta approximately 10 years to pay back this investment at a constant rate. To further complicate the point, though, another way of thinking about this is to look at the cash flow in perpetuity at a 7% growth rate. However, we also assume this does not yield any cash flow for 5 years while Meta is still building out the program. It would initially begin paying out in year 6. Utilizing a cash flow perpetuity with a required rate of return of 12.5%, we get a valuation of $90 billion. When we discount this back an additional 5 years, this is now worth $50 billion. However, we have to consider our investment. Meta has increased its capex by about $14 billion per year on virtual reality. Meta has said they will spend slightly less, but still in excess of $10 billion. Even if we were to give them 2 years exactly, the company will still end up spending in excess of $50 billion. It is harder to estimate the revenues Meta will generate to offset this loss. Currently, the company has a loss of $26 billion on virtual reality compared to its $31 billion spend. With decent revenue generation, Meta could limit this total loss to $40 billion. This is a huge risk for a reward of $50 billion. In order for this investment to be profitable, it must be wildly more successful than the Microsoft Xbox gaming division. Thus, the company has little upside that I can calculate from this investment in virtual reality. However, the upside does seem to come from canceling virtual reality entirely and allowing the business to scale down with the core investment. If the virtual reality investment was cut entirely, the cash flow would jump about $15 billion, as the virtual reality investment would no longer be needed. This would be cash flow at $35 billion a year. We then can consider two cases: a declining business and a business that grows with inflation. For the declining business, we get a valuation of $260 billion, with a 1% decline and a required rate of return of 12.5%. With a growth rate of inflation, let's say around 3%, we get a valuation of $370 billion. Even after accounting for Meta's cash on the balance sheet, these both represent significant declines from Meta's current market cap. It is not all doom and gloom, though. While this represents a significant decline from my previous valuation, the major upside that is in Meta is the dynamics of their advertising numbers. Meta's advertising rates have plummeted due to the economy as well as the changes in Apple's iPhone to block advertising tracking. However, the number of ads Meta served has dramatically increased to offset this advertising rate decline. If Meta can recover their advertising rates, they will get a ton of torque from the increasing number of ads served. Given the risk of this happening, though, I currently believe the best timing to review Meta again is when it has reached our worst case valuations of below $370 billion and $260 billion respectively, rather than bet on any positive developments. This represents share prices of $158 and $110 respectively. I hope you have gained more perspective on virtual reality and the metaverse through watching this video. What do you think of Meta's drive into virtual reality? Do you think their spending is justified? Have I lowballed the potential profitability of the metaverse? Do you think social media users like Kim Kardashian will switch over to virtual reality? Let me know in the comments. Bye.